Right, so I'm going to talk about financial markets now. This is in theme 4. If you look in your specification, it's section 4.4, the financial sector. And the first part of this, 4.4.1, is the role of financial markets. I'm going to set this out as a big spider diagram like this, so you might want to do it on a whole page. These are the different headings, and I'm going to tell you a little bit about each of them. The main thing to know about financial markets is that they are set up, first of all, to be able to give services to economic agents. And they're also set up, really, to allow speculation by economic agents so that they can make money out of money. And financial markets are arguably essential in an economy for it to work properly, because they facilitate lots of things happening within that economy. If you didn't have financial markets and financial services, you can't do nearly as much in the country. So this actually links in quite well into looking at developing countries and where they have insufficient economic growth and economic development, because you might find that the reason that you have a lack of economic growth and economic development is because people aren't able to use banks, pension funds, insurance companies, and other financial services like that within the economy. That's something that economies try to put in place so that their economies can function better. And lacking those can cause a lack of development and a lack of economic growth. We're going to have a look at the main things that financial markets are used for. And when we're talking about these things, services and speculation, these are the two main things offered in financial markets. This is for the 3 economic agents. So that's for consumers, firms, and also government. And all 3 of these entities will be using the financial markets in different capacities. So if we start off with the really obvious ones, so first one would be saving. So this allows people to have savings accounts. It also allows firms to have savings accounts. And remember, if you have a savings account, you earn a rate of interest on the savings in that account. That enables people to keep their money safe as well as earning this interest. And this is also then used, the money in the savings accounts of people and of firms is then used to be able to lend out to other people who don't have sufficient money to be able to do the things that they might want to do immediately. So the next factor, if we look at lending, and lending, so this is people being able to take out loans, but also firms being able to take out loans. And this will enable, for firms, they'll be able to invest in capital, which will enable them to be more efficient and produce more. And in an economy, if we're adding to the capital stock, we're adding to productive potential. For individuals, you can think about the standard of living of individuals, because might they be able to now buy things because of having a loan that they couldn't do otherwise. The other thing would be looking at whether people will be able to do things like setting up their own business, which they wouldn't be able to do otherwise. So own business. And this links into what we talked about developing countries, was about microfinance. Microfinance is often given for people to be able to set up their own business. And this often happens in economies where they don't have established financial markets. They don't have banks which are able to lend to people to set up their own business. So if you do have banking systems, then you have lending, which allows people to set up their own business. So these are the 3 main areas where lending will be relevant. The next thing is that having a banking system allows, so facilitates or allows, the exchange of goods and services. So it makes the selling of goods and services and the buying of goods and services much easier. We take these things for granted and think that they're normal, but if we didn't have them, it would make a big difference.